Hey, this is Tyler Rosby, and I like to answer questions every once in a while, and especially when they're common questions that I'm seeing a lot of. Because let's face it, facing face to face with each other, there's a lot more that we can cover than if we're on the telephone or trying to send a quick email explaining everything. So, the question that I wanted to answer today is, what are closing costs? How much are they? Where do they come from? What do I need to know, right? So let's talk about closing costs in detail, because I think once you understand it in detail, it all becomes, much more understandable and just easier to put things together. Okay, so when I look at closing costs personally, I like to describe it as kind of three different parts. So I'll break them down into three different parts, so that way it's just easier to remember and also easier to kind of understand. So the first thing that you've got is third-party closing costs. When you go to buy a house or refinance a house, there's a lot of people involved. There's an appraiser, there's attorneys, there's underwriting, there's credit reports, flood certifications, all these fees, right? And all these third-party fees add up to be about $2,200 worth of closing costs. And it doesn't really matter who you work with to get your loan, whether it be someone like me or a local bank or an online bank or credit union or whatever. They all get paid the same way because we all have the same people involved in the process. So $2,200 is kind of your hard and fast number to use for those third-party closing costs. Hopefully you're following me so far. The second part of closing costs is what I call commissionable fees. And commissionable fees are going to be things like an origination fee, an application fee, and a commitment fee. And the reason I call them commissionable is because ultimately these closing costs are what go to pay the company or the person that you're working with. And there's nothing wrong with paying us for our time, but it's important that you identify that is what that is earmarked for. It's for compensation of the bank that I'm working with. So you've got, so far, if you're following me, third-party closing costs and then the commissionable fees. And to go a little bit deeper into commissionable fees, usually there's an origination fee that you have the choice to pay. And that's an important word, choice to pay. We'll go into that in a little bit. But the origination fee can be up to 1% of the loan amount. And then sometimes you'll see banks charge an application fee or a commitment fee, either in addition to or in place of an origination fee. And application fees can vary in cost, so can commitment fees. But ultimately, I want you to know that if you ever see any of those line items on a closing statement or a good faith estimate or a loan estimate form, you're going to see that that's a closing cost that's associated with the person you're doing the loan with, okay? And you're compensating them through closing costs. Not to be confused with the third-party closing costs, which are for other people, for about $2,200 or so. Then the third part, which nobody ever talks about, is escrows. Now, if you're choosing to escrow, which in most cases you will be, because unless you have 20 to 30% down, you don't even have a choice not to escrow, but escrowing is putting money away on a monthly basis for when taxes and homeowners insurance come due. And as you accumulate this money, it just makes it easier to pay those things, so that way it's not something that you're stuck paying 6 months or a year at a time, because a lot of people would be caught by surprise. So if you're following me so far, third-party closing costs, commissionable fees, and escrows. Those are the three things that if you're really looking at closing costs as a whole, those are the three things you want to go into. And when I say as a whole, the reason I look at them holistically is, I use whole a lot in this, love it. The holistic look, though, is what goes into your bottom line. That's what you're writing a check for come closing day. So if you ever get numbers from us, which if we're working together, which I'm assuming we are if we're sending this video to you, it's just important to remember that I always look at things as a bottom line number. What am I going to have to actually bring in when this is all said and done, considering any seller paid closing costs, any seller paid taxes for previous time, whatever, all of that totaled up, what am I going to owe? And that's the number we like to look at. So hopefully that's really helpful. Now, I'm going to go on for a little bit more of a rant, so if you've already caught up, you've learned what you need to know, close the window, no big deal. But the second part is understanding how mortgage companies get paid, because what happens if you start shopping around or if you ask your friends, hey, what do you know about this? You'll learn that there are some banks that either don't charge any closing costs or really cheap closing costs, or they don't charge an origination fee, right? And, what I want to believe as a consumer is that that's just a better deal. I want to pay as little in closing costs as possible. Help me find that deal. Well, I want you to understand how mortgage companies like ours get paid, because once you understand how we get paid, you can understand how we can start twisting all this stuff to be a marketing thing. And if you've started working with me, you know that I'm not really worried about marketing something. I want you to understand stuff, because ultimately all of our clients come into this process understanding they really have three choices on how they can structure a loan. Now that being said, I want you to understand how banks get paid first before I go into how we structure the loan. And this video is going to go a little long, but I want you to understand this. This is what we cover in our workshops, so if you haven't had the chance to go to one of our workshops, you're about to kind of get some of the nitty-gritty. So the first way that banks make money is through commissionable fees, which we've already covered. That was the second part of closing costs. And commissionable fees can be up to 1% in loan amount, an origination fee, and they can also be commitment fees or application fees, right? But those are what I call the front part, the front stage, if you will, of how mortgage companies make money. The second part they don't talk about, and that's why I like to talk about it, so you understand that it exists. And that is something called servicing release premium, or if you're working with a mortgage broker, it's called yield spread premium. So SRP is the shortened version, or YSP is the second shortened version, the acronyms. So that money is tied to the interest rate that you pay. So if you pay a higher interest rate on your mortgage, over the life of the loan, the bank's going to stand to make a whole lot more money. And they're compensated because of that. So what I want you to understand is if you're paying less in those upfront closing costs, any of those closing costs, whether it be the third-party costs or the origination fee, what's happening is you're paying a slightly higher interest rate to allow that to happen, right? And then the bank is getting paid through the servicing release premium or the yield spread premium, if you're following. Now, let's talk about the three options so you're going to see the whole picture here now. So when you look at this, we educate every consumer that they've got three choices when it comes to closing costs. I don't really care what you go with because we get paid the same either way. There's no incentive for me to point you in one direction or the next. The only thing I care about is what makes most sense for you and your family, to kind of fit your short-term and long-term financial goals. So the first option is going to be the lowest rate option. So the first option is going to get you the lowest payment, but it's also going to be the most money out of pocket because you're going to have to pay the most closing costs to get that deal. So I'm going to just give you an example. These rates are completely arbitrary. They have no impact on what you're actually getting, but for explanation purposes, they're what we're going to use. So let's say option one is the lowest rate choice, and that's 3.75% on the rate. So 3.75%, and let's say, to make it simple, you're borrowing $200,000. So you'd have $2,200 in third-party closing costs, and then 1% of that $200,000 is $2,000, right? So option one is a 3.75 rate with $4,200 in closing costs. Are you following so far? So that's the third-party closing costs and the origination fee get you the lowest rate. So option one, 3.75, $4,200 in closing costs. The second option is what's commonly known as a no origination fee loan or no points loan. And what that means is we don't charge you an origination fee. So in that case, you're only paying $2,200 in third-party closing costs. So option two, $2,200 in third-party closing costs, and your rate gets bumped up a little bit. And again, remember, by bumping up the interest rate, instead of being compensated by the origination fee, we're choosing to be compensated with a higher interest rate through that servicing release premium. So in this case, we go from what option one was at 3.75, maybe it's at 4%. So option two is 4% with $2,200 in third-party closing costs. Hopefully you're trailing or tracking with me. I have no way to acknowledge, so let's just nod our heads yes. The third option is what's commonly known as the low-cost or no-cost option. And that option is where you mark up the interest rate even a little bit more. And by marking up the interest rate even a little bit more, you're able to pay not just the origination fee through a higher rate, but you're also able to pay some, if not all, of your closing costs. So using the same example, same math, option three would be a rate of 4.25%, okay? And at 4.25%, you're not paying any origination fee, and you're getting a 1% loan credit towards your closing costs. So your effective third-party closing costs are only going to be $200. So option three is 4.25% with about $200 in closing costs. So you can begin to understand how the marketing really takes control of this conversation. Because if you come into a bank and you say, hey, what are your closing costs? I, as a salesperson, if I'm calling myself that, know that you're shopping closing costs. So which of those three choices that I just described to you do you think I'm going to give you? Option 3, of course, because it's the lowest closing cost option. Now, if you come to me and you say, hey, Tyler, what's your interest rate? Which option do you think I'm going to give you? Option 1, all day long, right? So you can begin to understand the marketing and sales side of this, and hopefully it makes a lot of sense. What I'll tell you is from 11 years of doing this as I record this, I have found that mortgage companies, no matter who you're working with, will be very, very, very close in terms of closing costs and interest rate. Usually the most I see a move is maybe a couple $100s from one bank to the next, and usually there's a pretty good reason that I can help explain if I saw that situation. Or interest rates are very, very, very close, within 1/8% if you're working with a competitive and reputable lender. So hopefully this just makes more sense of this. It's an 11-minute video. I can only imagine what this would look like in an email. So I hope you appreciated having it formatted into a video. Maybe it's a little bit more entertaining to listen to. But please do fire back with any questions that you have. I am happy to answer anything. I want you to understand this. I want you to feel confident about your decision. And I also want to earn your business. So let me know what it'll take to do that and make sure that all this stuff makes sense, because that's what we do. And we're looking forward to working with you. So thanks for tuning in, and I'm talking with you soon. See ya.